VA is actually a huge market, and it's a huge ability for you guys to try to get business. A lot of agents in this area just kind of like bypass it for some reason. I think it's fear of just something that agents don't know or they're not super familiar with, in my opinion. And so the plus is that we are VA direct. And so that means that once we pretty much process and clear to close a loan VA, we do not have to send it to VA for the second clear to close. That's the difference between a lender basically being VA direct or not. And so essentially what it means is, in order to approve certain loans, the underwriters, who are the ones that approve the loans, have to have a specific license. And so for an FHA loan, the underwriter has to have a license called a DE. And on a VA loan, the underwriter has to have a license called a LAP. And so many underwriters don't have a LAP, and therefore many mortgage companies, unless they're larger, are not VA direct. But VA is an amazing loan. Number one, they usually tend to have the best interest rates for the borrowers. They are 100% financing. And there's a misconception with VA that if your lender is creative, they can get around. And so this is what I mean. With VA, number one is the borrower does not have to have an income limit. So there's no income limit or anything like that, like there was on USDA or other products. There's no income limit on VA. In addition, there's a common misconception that the client can only get 4% seller assist. And so if you don't know what seller assist means, that means that when you have your closing costs and you have your down payment and you have your prepaids and you add them all together, your seller can essentially give you a credit to cover your closing costs and your prepaids, right? And so with VA, many agents believe that you cannot get your closing costs covered all by the seller, but that's actually incorrect. You actually can. There's a unique way of doing that, and the way you do that is you make the 4% that you get from the seller, you give that as a normal seller assist, and the additional 2% or whatever portion that you need, you make those closing costs as a seller paid on the itemization or on the closing disclosure, and then that's kind of how you kind of backdoor the additional closing cost assistance. So essentially, if you have a 580 credit score and you are VA eligible, which I'll tell you how to be VA eligible in a second, you can do 100% financing, you can get full closing cost assistance from the seller, and so you can essentially buy a house VA without one red cent. You basically pay for the appraisal and that's it. And in some cases, depending on the seller assist, the client actually gets their appraisal fee back at closing actually. And there's a kicker to VA that's like the biggest benefit of all, is that when we do loans, there is a thing called a DTI. A DTI is a debt to income ratio. What that means is we're going to take your gross income. Your gross income is what you get paid before taxes are deducted. And we're going to divide that against your housing payment. That's your front ratio. Your housing payment would be your principal and interest, your homeowner's insurance, your property taxes, and your mortgage insurance if you have mortgage insurance. That's what we consider your housing payment. Many would refer to that as a PITI, P-I-T-I, which is payment, interest, taxes, and insurance. That's what that stands for. So there is a front debt to income ratio, which is your housing ratio, and then there is your total debt to income ratio, which is your housing ratio, plus all of your debts that are on your credit report. So car payments, credit cards, things of that nature, right? So in normal cases, let's say conventional loans, you can only get approved for 50% debt to income ratio. So 50% of what you make versus what you earn. But on VA, there is no debt to income ratio, meaning you can have somebody that has an 80 debt to income ratio and they can still buy that house. So the caveat or the way that happens is that when you do a VA loan, you have to get an automated approval. And so there is a system that we enter all the borrower's information in, essentially their application, and we run it through this automated underwriting system, and it takes all of the algorithms, so the credit, the assets, the income, everything combined, and depending on that complete algorithm, if that customer has a good profile, in most cases, it's going to omit the debt to income ratio. So imagine being able to tell a customer that they can buy a house with no money out of pocket, with the best interest rate in the industry, and they don't necessarily need the income to qualify for it. So that's a really good loan. And it's also a community, I feel like. And so once you start doing VA loans, it seems like clients will refer you to other folks in their community, essentially. The way to determine their eligibility is when someone is in the military, a client, when they complete their military time, they get either discharged or honorably discharged and things of that nature. When that occurs, the VA will give them a form called a DD-214. That is something commonly asked of your client to provide to their lender to see what eligibility they have VA. And then we take that DD-214 and we run it through a system with the VA, and the VA then issues us a certificate of eligibility, which is also known as a COE. So if you're doing a VA loan, you may hear us say, hey, we need the customer's COE, or we need the customer's DD-214, or we're waiting for it. And so we basically pull this certificate of eligibility, and it confirms for us that your client is eligible and at what entitlement they are eligible for. And so the entitlement determines their funding fee. So you guys understanding everything so far?
Yes.
Am I talking too fast?
No, you don't.
Okay. So basically we take and the certificate of occupancy will have an entitlement percentage on it. Usually it's $35,000 is the entitlement amount, and the $35,000 amount on the COE, which is entitlement, realtors or lenders often confuse with like money or like a numerical percentage of the loan in some way, but it actually has nothing to do with like, they're not eligible for $35,000 extra or anything weird like that. It's pretty much what determines their funding fee. And so the coolest part about VA is, again, they have 100% financing. They don't need a debt to income ratio if they get an automated approval. They only need a 580 credit score. Their interest rates are the best in the market. And then above all of that, they don't have monthly mortgage insurance. So there is no MI on a VA loan. There is a funding fee. That funding fee goes directly to the VA. It's financed into their loan over the entire 30 years. So they don't actually pay that out of pocket. And that is what the COE will determine, what that funding fee amount is. And it can vary from, somewhere around 2.5% to 3.3% of the loan amount. So it is a good amount. And oftentimes, VA buyers get confused by why their sales price is, let's say, $300,000. Their expectation is that their loan amount is $300,000, but in some cases their loan amount might be $306,800. And they don't really understand why, and that's because the funding fee was added to their loan amount and then financed over the full 30 years. And so that's basically how VA works. It's actually the most amazing loan. I think it's the best loans for customers, and when a lender takes an application, or when you guys are doing a BFI, for example, one of the first questions you should ask is, did you ever serve in the military? Now, some of the little loopholes that we run into are, as you know, in the Spanish community, a lot of times we say we're married and we're not really married, right? Well, it's a common thing in our ethnicity, I feel like. On VA loans, you cannot have a significant other or co-applicant unless it's a spouse. So you cannot have a legal spouse. So you cannot have not even someone just on title, where oftentimes we'll have a loan where the loan itself is in the name of someone, but the titles may be in the name of the borrower and the spouse. On VA, you can't do that unless they're actually married. And I've had clients actually go out and get married because, maybe the girlfriend's putting up the down payment and she doesn't not want to be on title, obviously, and so they'll get married to put her on title. So there's no seasoning on the marriage. They just have to be married by the time of closing.